Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm lucky enough to be joined by managing director and technical strategist Todd Sohn to talk all things markets. But first, Todd, how are you doing today?
Hey Ross, I'm great. How are you?
Yeah, doing really well. Appreciate you asking. A lot to cover today, but I feel that we have to start in a place we've started for the last few of these videos, which is with the big move in interest rates, and particularly at the longer end of the curve. The 10-year has just broken through 15-year highs and has been ascendant over the last few weeks. So, what is your take on the move in rates? What might come next, and what it means for the broader market?
Yeah, great question. And the long end of the curve is seemingly the center of the financial world right now. Two observations I'd give. Number one, from a sentiment perspective, we found it interesting that in the latest Bloomberg survey, rate forecast survey, for the end of the year and even through the first quarter of 2024, there were no observations that had the 10-year ending above 5%, right? So the idea of the 10-year yield going even further than it is today with a five handle on it seemed, I don't know if unthinkable is the word, but just not on people's minds. And so that is perhaps what's occurring here right now, that we're going to push sentiment to the edge. Secondly, keep in mind, long duration, whether it is a bond ETF or a bond product, it's fixed income, but with equity-like volatility. The TLT over the last year has had a larger standard deviation of returns than the S&P 500. So while you may want to lock in those rates and get that yield income cushion, keep in mind the price appreciation aspect is adding volatility to your portfolio. So it's a little bit tricky, especially when you have short-term treasury bills offering 5% right now. So while the yield move may be getting a little bit aggressive to the upside and is definitely agitating the equity markets, just keep in mind the volatility there may not be worth it for your portfolios.
Yeah, I think that's a great point. I mean, it is fixed income, but as we've seen over the last couple of years, there can be big price volatility in the intermediate term in these bonds and bond products, especially when you see a move in interest rates like we've seen over the past couple of years, which has been pretty historic in nature. And you mentioned that move has pressured equities. We've seen weakness in August and September. But I'm curious, are there any pockets of strength on the equity side of the ledger where, folks could play offense even amidst a move in rates like we're seeing right now?
Yeah, well, I'll tell you what isn't working right now. That is bond proxy like sectors, staples, utilities, real estate. They are being immensely impacted by this rise in rates. There is not necessarily a need to reach for yield in those sectors right now. Conversely, energy has acted well. Over the last year, it's basically sideways, but recently the sector has seen some strength, which we like. We don't think it's too crowded. And then when you go up the cap scale within tech, performance there is generally still okay. I think that's much more of a hideout space where you have Apple and Microsoft maybe a little bit more immune to rates than a lot of the companies down the cap scale. I do want to keep an eye on consumer discretionary. It's held up okay relative to staples. That's a good thing. That's probably more staples weakness than anything. But it has started to stall out versus the S&P 500. And so maybe that's a little bit more reflective of this last leg up in rates causing a little bit more pain on consumer stocks and maybe some fears about consumer wallets in the future. So just keep a very close eye on that. It's not awful, but I would just mark it down as perhaps a yellow light heading into next year.
Makes sense and will do. Finally, I want to end. You do a lot of work on ETF market and the flows of investor dollars in and out of those products and get a good read on sentiment and positioning. What are you seeing out of positioning, in the equity and fixed income markets? Where are people a little aggressive? You mentioned sentiment around the 10-year treasury, but where are some other pockets of either aggression or maybe some fear that you're seeing out there?
Yeah, the most aggressive in our work is anything that is short duration or cash-like, and that includes money market funds. They have taken in over $1 trillion in inflows over the last year. Now, that makes sense given where rates are, but we also think that it might be a little bit offsides, especially if equities are to go on another run here. As for broader positioning, flows ran hot into the summer. They have cooled off here. I wouldn't call them apocalyptic or anything like that. But what I am keeping an eye on are volumes into inverse ETFs. Those are ETFs that go short the market. And when you see a spike in the amount of dollar volume into those ETFs, that usually reflects a very emotional market and one that is perhaps getting too pessimistic, too negative on stocks. We haven't seen that spike just yet through this little correction over the last couple of months, but I do want to keep a very close eye on that. That'll tell us when maybe a little bit more of a capitulative environment is taking hold. So again, money market funds the most aggressive, and then we are just closely eyeing the daily volumes into inverse ETFs for a better read on near-term sentiment into the end of the year.
Makes sense, and we always love a takeaway for something to watch going forward. So, Todd, thank you so much for the time as always, and hope to talk to you again soon.
Same to you, Ross. Thanks.
Thanks.